Welcome to another episode of The Financially Free Investor, where you will learn information and strategies on how to become financially independent by investing in real estate, something that is not taught openly in our society today. Financial freedom matters so you can live a bigger life, retire early, and do what matters most to you. Get ready to hear tried and true methods to becoming financially free with your host, Jordy Clark.
Hey everyone, welcome into another episode of the Financially Free Investor. Today, I wanted to hop on here and talk a little bit about something that, everyone's talking about right now. It's interest rates. And more importantly, I wanted to talk about equity. So again, I'm going to talk about this through the frame that I kind of see the world, which is through the Utah real estate market. Most of our portfolio is here in Utah. Most of my clients invest here in Utah. And so, that's kind of where we're going to look through the frame, but this will apply anywhere else that you're investing as you start building your portfolio. So, for the last couple of years, it's been really interesting because we have been almost spoiled with these low interest rates. If you look at a 70-year period of historical interest rates, the last couple of years have been at all-time lows. And part of that is because all of the stimulus that happened when the cerveza sickness hit and all the lockdowns happened, and the Federal Reserve and the federal government just started pumping money into the economy, in the form of stimmy checks and unemployment benefits, and a lot of that, frankly, was probably needed because the government told us that we had to shut our businesses down, that we couldn't go to work, whether that's constitutional or not, like that's a different episode. Yet that's the reality of what happened. So, money it's like a current, right? It's a river. If you dam it up and you block it, all of a sudden it stops flowing. Well, that has an effect everything downstream. So when everything shut down, they just pumped a ton of liquidity into the markets, not only the capital markets, but literally into other people's bank accounts. And, it was kind of just a like shotgun approach where it was just throw as much money out there as possible and see, what happens. Probably maybe more academic than that, yet still doesn't change the fact that they just printed a ton of money. So as a part of that, there was a lot of fear in the stock market when the stock market went down by 30% in, March, April, May of 2020, and then quickly rebounded because how fast the Federal Reserve was to push liquidity into the markets. So we got these super low interest rates, and anyone that still had a job that, could have refinanced saw mortgage rates go from, 4% to 3%. And all of a sudden everyone like rushed in and refinanced. At least that's how it was here. So all the loan officers were just doing phenomenal. They had this refi boom. Everyone's getting super low rates. It's kind of like an Oprah moment. You get a 3% interest rate, you get a 2.9% interest rate, you get a 3% rate. And everyone was loving it. It propped up the real estate market. Prices went bananas because everyone's like, holy cow, this interest rate is so cheap. Well, fast forward 2 years and all of a sudden we're seeing record inflation that we haven't seen, in 40 years. Gas has doubled. Everything's gotten so much more expensive. Well, who saw this coming? Well, pretty much everyone that just understands simple supply and demand. If you're playing Monopoly and you have $200 every time you pass go, well, all of a sudden you change it and you start paying yourself $1,000 every time you pass go, you now have 5 times the money. And when you pass that property that you want to buy, well, you've got a ton of money sitting there. So you just buy it, right? You don't even care what the price is. If someone passes on it, the bidding war starts and it goes crazy. And while that's just in Monopoly, a lot of that is true to our real lives. So we saw these crazy bidding wars happen in real estate. The stock market got, back up to its all-time highs pretty quick. And some companies just went on a crazy tear, and real estate was like shot right back up. Well, part of the problem here in Salt Lake is a lot of people pulled their houses off the market or didn't list their houses. And then, when we started seeing the nation kind of shift around because, some people didn't want to be in other states and they wanted to be in different states, and they started moving, Texas, Florida, Utah, Idaho, Arizona, they all started benefiting from this almost like migration that was happening in the United States. Well, we saw a ton of people coming from out of state and they're like, holy cow, 500,000 for this house. That's cheap. Let's go 600,000. And people are just going crazy over price, non-refundable earnest money. And at the same time, you had all the people who decided to stay put. They're just refinancing their interest rate down. So now they've got a cheap payment, which is good for them. We definitely refinanced as many properties as we could. And now all of a sudden we fast forward to 2022 and we've got super high interest rates. Almost everyone has equity. If you bought 3 years ago or longer, my guess is you've got, even if you put down only 5%, my guess is you've got a ton of equity, 20, 30, 40% equity, depending on, where you bought, how long ago you bought, how much you put down, a lot of variables, right? Because stuff just started going nuts. Well, I was having a conversation with some friends the other day, and they were like, hey, we want to refinance because we owe, I'll just make up some numbers that are somewhat relevant. We owe $400,000 on our house, and it just appraised at $800,000, and we want to start investing and buying rental properties. But we're stuck at this 2.9 rate, which was phenomenal. But we're going to go to 4.5% on the rate. And I was like, holy cow, guys, your interest rate is not your problem. And this is really where I wanted to go on this episode. So thanks for bearing with me for the last few minutes. I wanted to build up to this so that I could stand on my soapbox and chat about it real quick. And this is the conversation we had. And I've had this with like probably 8 or 9 other clients. I said, well, that's great that you've got like a 3% interest rate. Your payment's super affordable, but you have a ton of equity. And equity can come and go. Don't get me wrong. But, for like, it would have to be a dramatic crash for property values to be cut in half. Is it possible? There's a lot of people that say, sure. There's a lot of people that say, no. The reality is, like, we never know what's going to happen, right? The equity in your house, and this is the big question I asked them. I said, if it's not really, you're going from 3 to 4.5% or whatever that may be. Like, yeah, it's important, but you have so much equity in your house. How much is that equity paying you every month? So, $400,000 in equity, or 500,000 or $1 million or 300,000, doesn't matter. But the question is, what is that doing for you? And for most people, the answer is probably nothing. The equity is doing nothing for me. It doesn't return me any money. In fact, it probably costs you money when you look at it, because it just sits there. Now, I love equity. Equity is a great thing to have. It's a cushion in the event that something goes wrong. I'm not saying go out and leverage yourself to the hilt and, buy tons of properties, because we saw what happens when you do that. But if you can take, call it $100,000 in equity out of your house, even if your interest rate goes up and you pay a little bit more in interest, as long as you're comfortable with that payment, the question then becomes, how can you invest that $100,000, or again, whatever the number may be, to get you closer to financial freedom, right? So what asset could you put that $100,000 into that's going to return you more money every month? And this is the way I think we need to be thinking about assets and our journey towards financial freedom, because, a lot of the times we don't think about it that way. Instead, we're just trained to be like, get the lowest interest rate possible, put your mortgage on the shortest term possible and pay extra every month. And there's a lot of me that disagrees with that, because I would rather have, even if I didn't deploy, well, let's say I take out $100,000 in my house and my payment goes up a couple $100 a month because interest rates are higher and whatnot. If I say sit on 50,000 of that, I actually have the ability to use that. And then let's say I use the other 50,000 and I go buy a single family rental or a duplex or something, find a really good deal. Well, if I keep 50,000 in a savings account, a lot of people would be like, oh man, that's costing you money, right? Well, the reality is, like, if you're self-employed or you have a W-2 or whatever job situation you find yourself in, if for whatever reason you lose your job and you can't pay your mortgage, do you think that the mortgage company cares that you have 50% equity? No, you're going to stop paying. And what are they going to do? They're going to do what any lender is going to do. And they're going to start calling you being like, hey, you need to pay your mortgage, because they're just servicing it. And there's another investor that actually owns the note. We won't get into the weeds there, but they're going to start the foreclosure process. And depending on what state you're in and the laws around foreclosures, they're going to start foreclosure. And, in talking to a lot of people who were invested very heavily in 2003, 4, 5, 6, leading up to the Great Recession, the first houses that got foreclosed were the people that had the most equity in it. So, if a bank's looking at 200 properties and 100 of them completely is delinquent, the other 100's like kind of slow playing, well, they're going to go for the completely delinquent first. And then of those 100, they're going to look at everyone that has equity and they're going to say, okay, keep foreclosing on them. They're going to look at everyone that doesn't have equity and they're going to say, okay, well, keep foreclosing on them, but don't get too aggressive, because we don't want to end up owning something that, it has no equity in it. We can't sell it. We can't do anything with it. And it's going to be a drag on our balance sheet. And again, I've never worked for a bank. This is just kind of what I was told happened in 2008. So everyone that, even if you'd been dutifully paying your mortgage for 29 years and you had 1 year left, they'd still foreclose on you. So that's going to put you in a position that you're forced to sell, or you have to somehow modify. But, if you have options, they're going to be like, no, just like pay us off. We want our money back, even if you've been dutifully paying forever. So, in a situation like that, my question becomes, would I rather have $50,000 in cash in a bank account that if I lose my job, or, I'm in a car crash and incapacitated for a few months and I can't go to work, and, that money can continue to pay the mortgage every single month in the event that something crazy happens? And this is why I think it's so important you have a cushion, because if you've got that 50,000 as equity in your house and you haven't tapped into it, can you use it? Well, the answer to the question is no. You can't use equity to make payments on your house, right? The lender is going to go, no, you're nuts. But if you refinance when times are good, and times are still good right now to refinance, even though interest rates have gone up, would it have been better 6 months ago? Sure. But even with interest rates going up now, we take a look at all of our assets and we go, okay, where do we have a lot of equity? And do we want to sell that asset and, use a 1031 tax deferred exchange? Or do we want to tap into it with a home equity line of credit or a refinance? And, I'll do another show on the pros and cons of refinancing, the 30-year mortgage versus HELOC. For the most part, I really like 30-year fixed rate mortgages that you're getting on, single family houses, duplexes, triplexes, fourplexes, townhouses, condos, because those are backed by the federal government. And that is like the best debt that you can get, especially when you're starting out buying properties. Those are the properties you're ultimately going to buy. And if you can get 30-year fixed rate mortgage, your payment is not going to change a whole ton. Versus, if you go out and take a big home equity line of credit in 2007 and 8, there were a lot of banks that they dried those lines of credit up instantly. So if someone had a $200,000 line of credit tied to a house and they had $0 of it used, that bank just basically closed out the account with no notice. And the loan documents that we sign basically give them the right to do that. No one ever reads them because we just want the money and we just want to close on the HELOC or whatever. But they can totally just close your line of credit and not allow you to draw any more down on it. And they can do it in a moment's notice. So, when COVID first hit, I tapped every credit line I had and I threw it in different bank accounts so that bank didn't have access to it, because I would way rather pay a little bit of interest and be sitting on some liquidity than not, right? So anyways, getting back to the original conversation that I've had with a couple of clients lately is, your interest rate matters a lot less than what your equity is doing for you. Because at a certain point, you'll get enough equity that you can go out and buy more assets with that equity. And that's when this journey starts kind of compounding on itself is, when your assets can start buying assets for you, you kind of just start this exponential growth curve. And, I've experienced that in the last couple of years where, you just buy a house or two a year, and then all of a sudden 3, 4, 5 years goes by and you've got some equity in some of these and you go, hey man, this one, it's not in a desirable location. It's a good market to sell right now. Maybe we look at selling this one when this lease is up with these tenants, and we can redeploy that capital into 3 or 4 or 5 other properties. And what's that going to do for me? Well, A, it's going to spread my risk out on 4 or 5 different tenants versus one. And B, it's going to spread that same risk out into a couple different areas, right? Because you never know, like, if areas are headed up or down, or, we like to think that we have this crystal ball, but the reality is, like, some areas will appreciate like crazy, and then others will be like, yeah, that was good appreciation, but nowhere near this neighborhood over here. So it spreads out your risk into a couple different things. And we're headed into a very, in my opinion, long period of inflation. So I think that's 3+ years of 5% or more appreciation or inflation, which means we're going to be able to raise rents every single year on every property we own and every door we own, $100, $200, $300, depending on, what we're asking for in rent. And guess what? Most of my payments are fixed. So if I own 5 doors versus 1, and we're increasing rent, call it $200 per door. Well, I now, fast forward a year, I'm now making $1,000 more a month instead of just the 200 extra that I would have, because I only had 1 door versus 5. And if you kind of compound that out 3, 4, 5, 10 years down the road, it starts getting really cool to own, more than one asset. And by all means, like, owning 1 or 2 is great. Don't get me wrong. Yet if you can leverage into 2 or 3 more and do it in a way that makes sense, right? You also need to know that you're protecting for any downside. So if we do slide into declining or downward pressure on pricing, then you're going to be okay. You can ride out a storm. If rents go down a little bit, you'll be okay. Do it smartly. But I think it's way better to be diversified and kind of spread out into a few different properties. And so, this is a conversation I've had countless times. Like, it's probably been more than 10 times in the last 6 months, just because the equity is only good if you use it. And guys, with inflation being as high as it is and how much money was printed in the last 2 years, stuff is not going to get less expensive. Cars are not going to be less expensive to make in a year than they were 2 years ago. So get used to it. We're going to have higher prices. We're going to have higher prices in homes. We're going to have higher prices in cars. Everything is going to cost more. The government's going to tax you more, and you need to be prepared for it. And this is all a part of your journey to financial freedom, is the knowledge and learning and looking at these macroeconomic trends that you can ride those coattails of bigger institutions, bigger people, bigger investors, whatever that may be. And that's kind of your way into more of a leveraged approach to financial freedom versus trying to save $400 a month for the next 60 years so that maybe you could have $1 million in retirement. Well, I can promise you that $1 million in 40 years isn't going to buy very much. Just like, 40 years ago, $1 million was a lot of money. Well, $1 million today really isn't that much money. Because if you look at the average cost of a house, I think our average price in the Salt Lake area right now is $650,000. 30 years ago, people would have been like, that is nuts. But the average house was 90 grand 30 years ago. So, and cars were, 15,000 brand new. Well, now you can't get one for less than 40. So stuff gets more expensive. It gets more expensive to make everything. So anyways, I'll hop off my soapbox here. I just wanted to hop on for 15 or 20 minutes and clue you into this conversation, because I've had it so many times. And I think it's so important that rather than just focus on interest rate, we look at everything: equity, what it's doing for us, what we're going to do with the equity, how much liquidity we have versus how much we want to have, what's our cushion, what's a worst case scenario, what's a best case scenario. And then once we kind of have all of this data, then we make a decision versus just looking at one little piece to the puzzle. So hope that helps. And I'm so glad to be here. helping you as we all move towards financial freedom. So guys, have a great day. Thank you for joining me for another episode of the Financially Free Investor. If you found value in this episode or know someone who would find value in this information, please share with them, subscribe, and send us a review.